Hey everyone, this is Dan Russo, the Chief Market Strategist at Chaikin Analytics, bringing you some thoughts and ideas on finding relative strength in the current market environment. Obviously, we're going through some unprecedented weakness here in the equity market, at least in terms of the recent past. And I think it's really important for investors to resist the urge to kind of completely tune out. I really think it's important to stay engaged to the best of your ability with what's happening in the markets because ultimately we are going to find a bottom in the market. Nobody knows when that is going to be. And we want to start thinking about what we can do to take advantage of that. And I think that one of the best things that investors can do is continue to do their work. And part of that work and part of analysis of the equity markets and all financial markets really is a focus on relative strength. I am of the view that when we do eventually find a bottom and begin to build a base, the areas of the market that have held up the best are likely to be your leadership through that base building process and ultimately lead on the way back up. So we're going to look at some of the areas of the market that are currently showing relative strength. And we're also going to take our analysis away from equities as well. So let's dive right in. First and foremost, we're looking at the SPY here. The Spider S&P 500 ETF is our big proxy for the broader market. And we are still looking for an initial low as far as I'm concerned. We're looking at a weekly chart here. We have a 50-week moving average, 200-week moving average, which is given way. A lot of people looking for initial support around the 2018 lows. That is now being tested. Should that break, I think we have to start thinking about 200 to 210 to the downside. That's the breakout from the consolidation here in late 2016. And should that give way, I do think we have to be thinking about 170, which lines up roughly with 1700 on the S&P 500. But what should immediately jump out at people is all of the obvious support levels have been broken, like they're not even there, right? So they're levels of interest at best. We're not hanging our hat on anything. What we are looking for is signs that selling pressure is abating, and we just haven't seen those yet. For right now, the levels of interest are the 2018 lows, the 2016 breakout level, and then the 2015, 2016 lows. And you can notice that the weekly RSI is deeply oversold, confirming the weakness in the price trend that we're seeing here. We also think that after an initial low, we're likely to see an interim rally, but we think that that initial low will likely be tested. And the reason for that is because this decline has been precipitous. And looking back through 40 years of market data for the S&P 500, what we're looking at here is a weekly chart of the S&P 500, and then down below the 4-week rate of change. And what you'll see is that the current 4-week rate of change is worse than anything we've seen to the downside over the past 40 years. That includes the 1987 stock market crash. That includes the bursting of the internet bubble. That includes the global financial crisis in 2008 and 2009. And what's interesting to me, and I've gone back and looked at this in a little more detail, is that when you see a 4-week decline that generally takes you down more than 15%, that initial low in the market is not the ultimate low. Oftentimes, the initial low is tested and even breached. And what we'd be looking for on a test and a breach would be less selling intensity to give us a signal that a base may be forming, right? We're not seeing it yet. We haven't even had the interim rally yet, as far as I'm concerned. So that's, we do think that after a rally, should one materialize, the lows are likely to be tested and possibly even breached. Breadth is washed out, and breadth is one of the key data points that we'll be looking at. Right, breadth is obviously washed out. The percentage of stocks above their 200-day moving average is 3%. The percentage of stocks above their 50-day moving average is roughly 1%. So what are we looking for? Well, first and foremost, if the market rallies, obviously we'd want to see these breadth metrics rally. And then on a subsequent pullback in the market that retests or even undercuts the initial low, we would want to see these metrics make a higher low, known as a bullish divergence. That would give us a signal that selling pressure has abated, that the test is not as intense as the initial low, and a base is likely forming, and it makes sense to start to look for the areas of the market that had held up the best during the bear market for potential leadership and possible ideas. But what if we're wrong, right? The consensus view is rally retest. What if we do get a V? Not the base case at all, But what if we do? I'd look for these metrics to sustain a level above the 30% mark to give me an indication that we're likely to continue higher, right? So keeping an open mind, the base case is a rally and a retest, possibly a breach, but we have to think about what if that is not the way it plays out. The alternative view would be to look for a sustained hold above the 30% mark, similar to what we saw back after the V-shaped rally out of the 2018 lows. 2018 low, precipitous decline, no retest, sharp V rally for the S&P 500, right? And then once we got back above 30% here for the percentage of stocks above their 200-day moving average, that was a solid signal in January, so early enough to kind of get you on the right side of that trade. So those are two scenarios that we are watching for very closely here. We would also be looking for volatility to begin to roll over. What we're looking at here is the 10-day moving average of the VIX. And it went out at a high on Friday. There's no two ways about it. We're above the levels seen back in late 18, early 19. We're above most historic levels as far as this metric is concerned. So we'd actually want to start to see this begin to roll over and continue to move down, even on a retest of the lows, to give us a sign that some of the fear is coming out of the market as well. So those are key data points that we're looking at. As we look at the world through a Chaikin Analytics lens, those of you who know us well know we have our 20-factor model. And as I look at the S&P 500 right now, there is only one bullish stock in the S&P 500. Here's the SPY, one bullish stock, 137 bearish stocks, 360 in the middle. All of the sectors have, with the exception of healthcare, and for those of you who are interested, that one bullish stock is Regeneron. All of the other sectors have zero bullish stocks, right? Material across the board carnage. There's no two ways about it. All sectors have been hit hard, but what we're interested in from a sector standpoint, and when we try to identify the leaders coming out of this, is what's held up the best, right? And there are 6 groups that have held up better than the S&P 500 over the past 3 months, and really over the past month as well. Over the past 3 months, S&P 500 down 29%. Staples only down I can't believe I just said that, but only down 20%. That's massive outperformance. The groups that are outperforming, i.e. going down less, are Staples, tech, healthcare, comms, utilities, and REITs. Now, utilities and REITs are outperforming as you would expect, as they tend to be defensive in nature. Same with the staples. So what I want to focus on is the areas of the market where we could see leadership on a turn. Because if we do turn, I would expect folks to rotate out of these defensive areas and into what's really held up well. So tech, healthcare, and comms are where we're going to focus the bulk of our attention today. So if we take a look at tech here, very simple ratio chart in StockCharts, your ticker symbol, the one you care about, colon sign, and then the ticker symbol of what you want to compare it to. And all references here, we're going to compare our work to the S&P 500. The tech sector on a relative basis is in a steady uptrend as it has been since this low in early 2019. Above the 50-day moving average, above the 200-day moving average, and the momentum, the RSI of the ratio, is holding bullish ranges. So what does this tell me? This tells me that when we do begin to see signs that selling intensity is abating, I want to be focused on the technology sector when I'm drilling down and looking for ideas. Another area of the market that we like a lot, healthcare, and by we like a lot, I mean it's a relative outperformer. There's not a ton that we like on an absolute basis in the market now, but look at the relative performance of healthcare. Now, healthcare does have some defensive properties, but it also has areas like biotech and med tech that are offensive in nature as well. We're above the 50 and 200-day moving averages, RSI of the ratio coming out of an overbought condition, but notice on recent pullbacks, it never became oversold. So healthcare is another sector of the market where I would be doing my work and building my watch lists of individual stocks that are showing signs of relative strength, because when we do stabilize, healthcare is an area of the market that I would expect to continue to outperform, and as is communication services. Check out this base we're coming out of, right? I drew the line as a diagonal, and if had I drawn it horizontally, we'd be on the verge of a breakout for XLC relative to the S&P 500, right? We have a golden cross here with the 50-day crossing above the 200-day moving average, and we're seeing a breakout. Notice that during the tail end of the consolidation, RSI never became oversold, and it now is working back into bullish ranges. And this is an interesting area, probably one of my favorite areas, because it has both offensive and defensive properties, right? If we drill down on the holdings of XLC, There are names in there like Google and like Facebook and the video game stocks like Activision. But then you also have your stodgy, old school communication stocks like Verizon and AT&T. So this is a group that allows you to kind of play offense and defense. It has held up better than the overall market. Obviously, it's gone down, but we're looking for the relative strength. And this is what I mean when I say stay engaged. Continue to do your work and isolate the relative strength in the market and avoid the relative weakness. I hope that everybody found this helpful. And if you have any questions on relative strength, please feel free to reach out to me at Dan Russo _CMT on Twitter.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.